The first session is on founding a startup, and it is focused on getting your organization funded. The session will be moderated by none other than Murli Thirumalai, class of 82, VP and GM of Pure Storage, and we have two panelists who are very established VCs. Tim Guillory is the Managing Director of Sierra Ventures, and Naveen Chaddha, Managing Director of Mayfield Funds. These two VCs will be sharing their fresh insight on financial aspect of a company and what to look for in a CEO, CFO, and how to get your organization funded. So without further ado, I'll invite Murli Thirumalai on the stage to introduce our panelists and get started with the session. Thank you.
Request everyone to come in the front just in case you still want to network, it is okay, but please don't chat in this hall, just to be respectful of the speakers on the stage. So this is my humble request. My first preference is please participate, otherwise you go to network, please on the other side. Thank you.
Thank you, Puneet. Home stretch, folks, but we saved some of the best stuff for the end, as you will be able to tell in a few minutes here. So this is a session that I'm actually delighted to introduce the two panelists here. These are folks that I have known for a long time and owe a debt of gratitude to. To start with, when I started my first company, which was a terrible time right after the dot-com crash and before 9/11. So other than that, it was a great time to start a company. I had known Tim for a long time, and he had just sold his company Octane for what was a staggering amount of money. It was the largest software transaction, a record for a long time, $3.2 billion at just a couple of years before that. And sight unseen, he just came and wrote me a seed check and really kind of put us on the trajectory of getting the business started, and then went on to actually go on and add on a seed round and a Series A round. After that, I think we were we were your first investment as a new VC. And exit too. So Tim has an illustrious career. Both these folks, as you'll see, are both entrepreneurs and VCs, and have an amazing record in both these areas, right? Moving on to Naveen. Naveen has also been a serial entrepreneur. He started 3 companies. VXtreme was the last one that I remember. iBeam was the other one. VXtreme was sold to Microsoft, and he went on to kind of grow that business significantly. After that, he joined Mayfield and really redid Mayfield. In my view, Mayfield has completely transformed itself under Naveen, and our last startup was funded by Naveen. He actually pulled me along with some of my co-founders out of my retirement and put me back to work again. And I was really fortunate to get both his advice and his help in real terms. Both these folks are. There are two types of VCs. There are people who give you money and then just kind of ask you a bunch of questions, and there are people who call themselves an operating VC, people who come from an operational background and have run companies themselves. Both Tim and Naveen fall in that category. So it's a rare privilege and a pleasure for all of you to be able to kind of get folks who have been on both sides of the fence for a considerable amount of time. So with that, let me kind of get started and ask you each in turn, tell us something about your background, both as an entrepreneur and as a VC, and some of the things you're proudest of, a couple of accomplishments. We'll start with you, Tim.
Thank you, Murli, and thank you all for leaving your samosas and coming and sitting down here. I'm very excited to be here this evening, and thanks for the invite. So as Murli was mentioning, and I think that's very common amongst the three of us, we all have technical backgrounds. To give you a little bit on my background, I got my degree in electrical engineering in India. I came here, did my master's. I kind of fell into loving robotics, which was hot at the time, and came to work in Silicon Valley in LSI Logic, which is actually how far Murli and I go as friends.
That was our company.
That is correct. And LSI Logic was a place where I got my green card, and then the minute I got the green card, I went into a company called Scopus, which is the first place I had an entrepreneurial experience. And I guess the lesson learned, which I wanted to share with all of you, is that when you're in your 20s, you may not know what you want to do in the future, but you should know what you don't want. And when I was doing semiconductor work, I knew that is something I didn't want to do, and I wanted to, the minute I could, transition to an enterprise software company, which was Scopus. As luck would have it, that was the right place. Scopus went on to go public. I ran a portion of the sales organization and marketing. We sold the company for $700 million. And I kind of call that my live MBA because I learned all the tricks of the trade, including what engineering is like, how do you run marketing, how do you run sales. And that, as Murli was mentioning, luckily gave me the birth to start Octane, which I did in 95, end of 95, and as Murli was mentioning, ran that for 5 years. That was a well-timed exit, 3.2 billion, which is sort of the second lesson that when you launch, when you jump off the edge of the cliff, you have to build the parachute on the way down. You have to have the confidence that something good will happen if you're willing to put in the work. And I think Octane was the story of that. And then I was there for a couple of years and then met Peter Wendell, the founder of Sierra. I've been at Sierra for 20 years. And the firm itself is 40 years old, and I've been running the firm for the last decade after taking the baton from Peter Wendell in 2012. And we'll talk more about venture capital and what we do at Sierra, but really I'm honored to be here. And that was a hard question on what things am I most proud about. I had to kind of go back in time. I think Octane was one, and not just the exit, but the 350 employees that I had at the time and what it meant for them. I think, to me, that was one of the proudest moments in my career. And the second one is, I think, what we jokingly call Sierra 2.0, which is the new and improved Sierra. We've been working on that for the last decade, and what the firm has become under the leadership of my partners, Mark and Ben, and me contributing, of course. So those would be the two things I was the most proud about.
Naveen?
Great. So I'm from the other IIT. And it's debatable which one is better. I'm from Delhi, but probably I think yours is better.
You heard it here, folks.
I just want to avoid getting tomatoes on it. So I grew up in India, IIT Delhi, then came to Stanford in 92, and the internet started happening in 93, 94. So I got a lucky break to work on my PhD in the area of streaming video over the internet, and started my first company based on that. And when you do video streaming today, most of the patents belong to the founding team of VXstream. It was a professor and 3 students. And it grew very quickly and was acquired by Microsoft to become Windows Media. Once an entrepreneur, always an entrepreneur. Then did a second company, IBM Broadcasting, which we took public, which was a video CDN. Then did a third company, SaaS company. When SaaS wasn't SaaS, it was ASP, Application Service Providers. I joined the dark side of the business in 2004. So I've been doing venture capital for over 18 years. I've partnered with over 60 entrepreneurs, and have been really lucky to have worked with Tim on boards, having been in a partnership with Murli and his co-founders. And I think the thing I feel fortunate to be is working with great entrepreneurs who want to change the way we work, live and play. And it's really a privilege to be in this business, to be able to work with many smart people who are trying to change the world and make it a better place, and many of those are sitting in the room on the other side. And the proudest moment as a VC who only does emails, PowerPoints, and Excel sheets, it's hard to say that we do real work. The real work happens there. So the only two things I can remember is one, getting the opportunity at Stanford to really invent video over the internet and being one of 4 or 5 people who got a lifetime opportunity to work on something like that. And then the second thing I would say is got into helping underprivileged and got this bug on DEI like 4 or 5 years back. So I've been spending a lot of time and started a Mayfield Access for All program where we are taking students who are first-time college students from underrepresented URM colleges and URM backgrounds and getting them real-world experience on our nickel, on our management fee at startups. And it's a big thing for people. Right? So I think those are the two things. I'm pretty sure many more are to come. It's just the beginning. But the more we work with people like you, the more it's a privilege.
This session is called Founding a Startup, and we're lucky that both Tim and Naveen are kind of early stage investors. Of course, they invest through the life cycle and support the company through the life of the company. But one of the common questions that I had as a founder, and I get a lot as I meet other budding founders, has to do with the very early stages of a company. So, for example, I'll throw out 2 questions. One common question I get is, how do I find a co-founder? That's one question. That's a very difficult question to answer, but it is that. That's why I'm going to ask these guys that question, because it's difficult. The other one is, do I really need to build the prototype already before I go to try and raise money? So let's start with you, Naveen. What's your advice to folks on that?
I think the most important thing is to figure out what you're going to do and how big a market opportunity is that, and is the problem you're trying to solve really a painkiller for somebody, or it's a vitamin? Because there's so many companies in consumer, enterprise, nobody has the time. So you better be solving a problem which is big enough but mission critical for somebody that they'll spend the time, and if as a business willing to pay, or as a consumer willing to spend time with you. I would figure out after that, what are you good at, and be self-aware, and where do you need to team up with other people to complete the team, right? Building a company is not about a solo experience, as Tim mentioned, it's about a team. So some of them will be co-founders, some of them will be early employees. Assemble the team. Then, once you have an idea of what you're going to do, some validation that there is a need and it's a real painkiller, and have a stellar team, go talk to inception stage investors. Mayfield, in the 500 plus companies we have done, I think like 480 are inception stage, like yours was, people in pencil idea. So you have to do product market fit. Like you do product market fit for finding a customer, find the right investor which is appropriate for evaluating the stage where you're at. And then I learned through Murli saying that, hey, you better sell first and build later. So I won't build a prototype, make sure there's going to be somebody who's going to buy it. And that's the mistake people make, right? They have an idea, they basically just believe in it, go build it, and then later they realize, oops, the world didn't need this thing. So I think those are some of the things that come to mind. And then finally, with your investor, make sure you're aligned on values and what they're looking for and what you're looking for, because it's a marriage. Company building is a marathon. It takes a decade. So you have to be in the zone of trust of each other. So those have been some of the learnings. Yes, there will be rocky situations, ups and downs, but are they due diligence on them? Are they really going to be there for you when things aren't working out, right? And that's when the true character of people comes out. So those have been my learnings since 95 as an entrepreneur and then as a VC, that just it's a marathon. Take the time, study the problem, figure out your strengths, figure out what you don't know, and surround yourself. Right? Like this is not company building is not playing ping pong alone. You're playing a team sport, whether you play cricket, football, basketball. That's what building a company is. It's not doing research and publishing a paper.
Tim?
Yeah, Naveen made some really good points. I'll try to fill in a few maybe extra dimensions. So I think on the first point about the market segment and the research, I think the other vector which I spend a lot of time when I'm talking to an entrepreneur is the business model. Because you can go after the same market segment with an excellent business model or a business model that's not that efficient. And if you do the latter, your company ultimately will not have a very productive P&L, which ultimately is how the public markets look at any company. So it's the idea, the space, obviously you look at competition and so forth, but the business model is very important. That's one point. And the second on the team, and I'm a product of this through the two journeys I've had, which is the mindset that you need to have is one of growing the pie bigger and bigger and bigger. So in other words, I've got entrepreneurs walk in and say, well, if I get a co-founder, I'll have to give them X% and blah, blah, blah. Well, it doesn't matter if the overall pie is going to be so large that X% is going to be worth a lot, right? So the mindset you should have is to map your strengths and weaknesses, as Naveen was saying, find the co-partners that have skills that are complementary and a demeanor, right? Because there'll be countless times when shit's hitting the fan, and you want people that can actually stay with you, keep the course, keep the North Star, and go through that. And in that journey, your investor partner also has to be in the same mindset. So I would say, as Naveen was saying, that when you think about co-founders, in a way, when you talk about first check, and I certainly look at this, I expect to be in the boat with the founding team. I'm no different than you. I just don't show up at your meetings on Monday, but every single bump I feel as an early stage founder, investor, every customer that you land, I feel the same excitement and cheer. That's how Sierra has built its culture in support of early stage companies. So the co-founder question really is extended to the investor also, because anybody can write a check, but showing up and actually helping to build a business is where I think the wheat and the chaff get separated when you think about venture capital land, right? And the final sort of dimension to think about is that you shouldn't become a startup founder if you don't have the right mindset, because this is not a sprint. You have to be ready for it. It's a marathon. You have to have the training and you have to put in the hard work, and we'll talk about that maybe in the next few minutes on what that might be. But it is a mindset that has to take. There's no, I mean, many founders that say, hey, and we test for this actually when we're talking to founders, how big of a company do you want to build? And if the answer is, punching the clock at 200 mil, our funds are not interested, because that is, we want to build iconic companies with founders that want to build and leave a mark on the industry they're experts in, right? So you should get into venture-backed startups for the right reason. If you want to do a lifestyle company, that you should not take venture for that. Anyway, those are my comments to add to what Naveen just said.
Before we talk about sort of growing the company, you folks have amazing deal flow. You get a lot of folks coming to you with their plans and stuff like that. And knowing you both pretty well, you have an uncanny ability of picking the right teams and the right models. So how do you do that pattern matching, right? So let's start with you, Tim. What are some of the easy decisions? Why are they easy for you when you say yes? And by the same token, which are the easy no's? What is it about easy yeses and easy no's that you are able to kind of pattern match?
Sure. So before I answer the question, I want to throw out there for this room to think about the other side of the table, right? So understand that when you're fundraising, this is actually a sales process, it's a sales pitch. It is super important for you to know what is the need of the venture capitalist that you're pitching to, not just the product of the company that you're pitching. Because if you have not done that work and you're pitching a sector to me or a stage to me that I have zero interest in, then the likelihood of that being not a productive meeting is very high. You'd be shocked at how many times I get entrepreneurs walking in with zero prep on the industries that I'm interested in, and it's all, I mean, we've been doing this for like decades now, so there's a huge digital fume on what we like and what we don't like, right? So my point is, treat it like a sales process. All good salespeople don't think about what they're selling, they think about what the buyer wants. And so you need to do that work.
Check out your portfolios before you come back.
Exactly, and what is that interest, what stage, what type of entrepreneur. So I'll park that on the side. Now coming to what we look for, I do want to make one more point on understanding the VC. So this is an analogy I've used before. Our desks, you think of Sierra as SFO, right? And we are sitting in the air traffic control, and all these planes are trying to land, and they're calling saying, "Hey, I'm tail number 644 flying from Boston." And Naveen and I are constantly, these flights are coming in, these are inbound traffic all the time. And so what we have to do in real time is either send you off to Oakland to land, as in we're not going to do the deal, keep you circling, right, while we do research, or give you a straight path to land on runway 2. And that's the question. So the point I'm trying to make is, when you come and pitch, you have to understand that there are hundreds of planes circling, and not just our firm, but any venture firm that's out there, because there are 9,000 B2B companies that are born every year. And in a 3-year cycle that we look at investing a fund, that's 24,000 founders, right, trying to land the plane. So that's the second macro point on the other side of the table. Now I'll answer the question. So what I look for is, I try to do a lot of work on the industries that I think I'm interested in, which have a growth potential, because I fundamentally believe, independent of how good the entrepreneur is, it's very hard to learn how to surf, when the lake is flat, there's no wind, right? So the market that you guys have to be building in, to me, has to be exciting. So when I find a market that I think is exciting, and a team that has a particular angle on the market, has depth in the market, then that's an entrepreneurial project that I get excited by. So that's sort of the first clearing hurdle, right? So the converse of that is that you could be a great founder, but trying to build a company in a space that I have zero interest in, zero expertise in, or I don't feel it's going to explode, I'm not going to back that company, right? So that's the converse of the earlier point. Now coming down to the founder, so in my stacking order, it's team, it's a space, sector, and the business model. That's number one. I over-index in the business model. The next is the CEO and the team, so if it's a co-founder and their quality, and then it's technology and all the other stuff that makes that solution happen. The founders I really like, and I fall in love with, right, because I do seed investing and kind of pre-seed, seed, Series A, right, like that $2 million check, or 4 or 6 or 8 or whatever you guys need. I love founders that come in with a very deep perspective in a particular space that is unique. And the number 2 is that they've done their work. So to the earlier question, you don't have to build a prototype. You don't have to have of course, if you do it and you've sold a couple of customers, we'll take it. But the most important thing is, I want to see 20, 30 pages of customer conversations in detail, and tell me, what did that customer want, right? Is it an aspirin, or is it just, sort of a vitamin kind of pitch? And somebody that's put in the rigor to go deep into these customer conversations and try to really, with data support, whether there can be a company that can be built here. So I actually like founders that show up with, a spiral book this big, or 17 slides, and customer 1, customer 2, customer 3, customer 4. By the 16th page, I'm like, let's go build this thing, right? But you have to show up, and you'll be shocked at how many people come and talk about some Kubernetes, fancy technology, and I'm like, how many customers have you spoken to? 0. right? Bad idea, okay? So you don't need the prototype, but do the work, do the hard work, and get conviction yourself. And I think people like Naveen and I, what we can do is, look, we have a massive person CIO advisory board. Naveen has the same size, if not larger, right? We've got a very large signal. We can add to your 25 customer conversations with another 30. We can give you the capital. We can help you hire the team. But the initial work that, you know, which is the big aha, I think has to be done by you. So those are the...
I mean, what are the easy things you find?
Yeah, I think like a lot of things Tim said, right, like they resonate, but every VC has a different style of investing. So I tend to focus more on people and look for blue ocean opportunities through them. So I do the most amount of odd deals. One day it will be ride sharing, next day it will be used clothes, then it will be solar panels, then it will be enterprise software. So I get a lot of losses as a result, but I index on people because I'm trying to figure out, do they have some unique insight that I can listen to that most of the world doesn't know? Right? So I keep an open mind. I don't have a prepared mind. And it's different styles of investing, right? Like, it's like religion. Do you believe in religion? Which one you want to follow? So I over-index on people, and I'm looking for, similar to what Tim said, do they have some unique insight about the problem they're pitching? Do they have an X factor? And now, it's hard to define an X factor, but it's like if people have read the book Blink, right? Like you can pretty much tell, right? Like then you try to look for other qualities in their life. Are they going to give up easily? Oh, I tried it, it didn't work. Do they not only have the perseverance, they need the patience. And I try to look for how many times do they use the word I versus we, which tells me they're trying to build themselves or build a company. And then EQ and self-awareness and showing vulnerability is very important. So I actually don't spend as much time. My team helps me on studying the market and product. I spend 5-10 hours just asking these random questions to really figure out the psyche of the entrepreneur and see, do they have it in them to build something big? Because if you are doing these out-of-band areas, someday I'm doing an airport to solve Alzheimer's, next day it's all over the place. If people go see my investments, there's no pattern. So that means there'll be high failure. So pick the people right, because if you pick the people right, their initial idea may not work. But with a little bit of help and guidance, hopefully they'll be able to pivot to go after the right market opportunity. Remember what you guys pitched me and what it ended up becoming. And a lot of the weeks. So I think like both these styles work, and one has to just stick to what they believe in. So I am like very focused, and the whole positioning of Mayfield is people first. But as a result, we miss on markets where we are not digging holes. But some of my partners like Rajiv for 20 years have just done SaaS, and they do a great job doing it. And I think both these approaches are very complementary. So when Tim gives me a signal on a market, I made the mistake of not doing it. I bookmarked it. When Tim tells me something, I better listen. That's what he was reminding me. We have done deals together because he's world expert in something. And he really is.
And you know, I think my experience with you at our last company was that radical honesty actually helps, because then, as you said, you're in the boat with us, and that actually helps you kind of help formulate the solution, because it's very easy to know that there's a problem. Yeah, you know, it's not like we're trying to hide it from you or can hide it from you. So, you know, this, as you can tell, this session is like trying to capture an ocean of knowledge in a small cup of time. And I know that we have many other folks here who have their wisdom to impart. So what I think we'll do is, I think we have time for maybe a couple of questions. It would be good to, let me turn it over to the folks here. Tushar?
There's a
Hello. Yeah. So, hey Naveen, I'm Tushar. We have met many times before. Very specific question for you. did a panel today on on-prem to SaaS model transformation. Want to get your views, as we've done in the past. How do you see these companies playing out? A lot of companies are trying to do on-prem to SaaS transformation to compete against cloud companies. Do you feel they would actually succeed, or they're buying time before they die and public cloud companies will certainly kill them? Your views in terms of how the market dynamics is emerging. Thank you.
Yeah, and I think I would like Tim's help because he invests more in this area and my partner Rajiv does. So our feeling has been a couple of things, right? Like first, the world will be multi-cloud. And what I mean by that is they won't be just one cloud, it will be on-prem, it will be public, but you have to make sure you're not building features like TCP IP that just become free as part of those platforms. So you have to create some value and control that community, that it's really a cross-platform offering. And at the infrastructure layer, I think it's becoming harder and harder to build companies which are iconic, like we were part of one, HashiCorp, Tim is part of many of them, so they really have to be Switzerland, where the customer at the infra layer is not just going to tie themselves down to AWS. I think there's a lot more opportunity from what I've learned on the app side, because a lot of the on-prem software is moving one by one. It was first Sales Cloud got created, then Service Cloud, HR Cloud. Think about all the vertical SaaS applications. Think about intelligent apps which are AI and ML based, which were going to get built. So we remain very, very bullish, but trying to avoid these feature companies, which what Microsoft with Windows did, they'll keep adding more and more value to the OS. But would love to hear, right, like your perspective on this topic.
Yeah, I'm sorry, I didn't catch the first part of your question, but maybe you could repeat that.
So the question was really
SaaS or
about,
on-prem?
SaaS, is this really a temporary phenomenon because people, the infrastructure folks, the cloud folks will catch up?
Gotcha, okay.
Thank you.
Yeah.
So I think, Naveen, I think hit the nail on the head that I think the SaaS phenomena is in its second inning. I think it's got a lot of run ahead of it. And fundamentally because it is yet to unlock all the value that's potentially going to get unlocked as SaaS moves into vertical, payloads or business processes. And we are lucky enough to have a few companies in our portfolio that are actually in very narrow and you could argue somewhat boring verticals. Like one of my fastest growing SaaS company does manufacturing rebates. I mean, hands up if that's a boring topic. If I told you, at a cocktail party, hey, let me talk about my great company that does rebates, you'd probably spin and leave, right? But this company is just killing it. And that's an example, and healthcare and so forth are other, right? So that's, I think, one unlock. I think the other unlock is that just as we saw in the late 90s, when the database layer was, transactional layer was kind of put into place, all these horizontal companies mushroomed on top of that, right? So all the ERPs were born then, all the CRMs were born then, the first generation. In the same way, AI is think of it as another data processing layer in first principle or primitives, right? And that's unlocking a brand new set of value and processes on top of what was done before. So I kind of feel that AI layer is unlocking new business applications that could not have been built on a transactional database stack. So that is a whole other vector of value that's going to come, and I think there's lots of growth we're going to see in that.
I would add just one more thing, right? And I think you would agree, when you and I were building companies, they were all systems of record, right? Like databases, like a CRM system. Then they moved up in the last 7-8 years to systems of engagement, right? And now what you just mentioned, they're going to become systems of intelligence where AI will tell you what to do. So, right, from dumb systems, you're going to become intelligent system. And that's what technology is supposed to do, to make you better as human beings. And it's already happened in security. Humans can't catch those things, machine catch them.
Why don't we take one last question here? Animesh?
Thank you. Guys, maybe a corollary to the topic itself about founding a startup. Tips on how to know when you have to demolish the startup, harvest the knowledge and move on, and how to distinguish that from having a bad month.
That's a tough one.
It's a bad day or a bad life.
Well, I think the first thing to think about is, again, you always have to be intellectually honest to yourself, right? And then you're building the startup, and then there are many, many, many bad days. There are actually more bad days than good days, and that's a true statement of any startup founder, right? But when they're good, damn, they're good, right? And they make up for all the bad days, right? So that's how it goes. But I think that you'll get, so there's a natural sort of life that a company has because you're burning cash. So the wall is coming towards you as a founder, right? So in a way, your question is, on the one sense, the burn rate that you have is something that you need to kind of keep in sharp focus, because you controlling your burn rate also lets you either run into the wall at 60 miles an hour or slow it down and then experiment and maybe try a different idea, which is the point that Naveen was making earlier, right? So I try to tell my companies that you can burn VC capital, but it's much smarter to burn money that you're getting from your customers, right? So get money from customers, not from venture capitalists after the initial financing. So I feel that giving yourself the longest runway possible, being very frugal in the beginning, which is by the way we write small checks, because it's not about the ability to write a larger check, but big checks also bring on frivolous thinking. You tend to hire more. Your thinking is not as sharp, and all the other things that companies die because of just being too fat or not efficient. So I actually don't believe in I forget the words that some of our colleagues have used, blitz scaling and all that stuff. I mean, now you're going to see in the next 2 years the other side of blitz scaling, which is going to be horrendous, right? So we believe, and I tell all my partners, that are fun, that build company in stages, build companies with no stretch marks, right? Take money, get to the next stage, and increment the value so that the next investor is happy to pay, and you feel really good taking the money because you've actually incremented value, and on and on and on, as opposed to playing the game on where the market cycle is, and the chief capital will go raise 100 million when you're doing 400K in revenue, which was happening last year, right? So I would say be frugal, give yourself room for experimentation. When it starts working, then load up the bus and go for it, because the winner takes it all in venture. I think the math is 68% of the market cap in the category is taken by the leader. So you got to play the venture game with a lot of speed, but make sure that the initial value proposition holds.
Naveen?
I think the only thing I would add is when companies get into this situation, I just ask a few questions. Answer for yourself, is the market there? The market is not there, you can't do anything. Okay, the market is there. Is your product there? Yes, no. Because you're running out of money and you don't have the product. The third question is, market is there, product is there, are you executing? So if you go down that tree, you will know where the problem is and then decide, is it a bad month or is it a systemic problem? Right? The market has to be there. Your product has to be the right one for that market, what we call PMF. And then it's your sales execution. The product is $1,000 and you're hiring expensive salespeople to do it. It's a wrong GTM model. So diagnose the problem. And if it happens again and again and again, trust me, it's one of those problems. Either the market ain't there, or you have built the wrong product, or your go-to-market motion is wrong.
Well, as you can tell, this is an amazing set of folks here from both an entrepreneur sense, but also as investors. And unfortunately for us, Cinderella is turning into a pumpkin, and they have to kind of leave for other engagements. And I'd just like to kind of thank them both for being here, and you can try to get some of their wisdom later on after the session if they're around for a few minutes. Okay, thank you very much.
Thank you, Murli.
It's a pleasure.
Thank you.
Thanks so much.